Hey guys, Toby Mathis here, and I'm joined by Stefan Whitwell, and we are talking about private lending opportunities and the related risks of going into that. And so I'm going to set the table here. First off, Stefan is a CFP, a fiduciary.
CFA, but
CFA.
yeah.
All right, you're a fiduciary.
Yes.
Who is a financial professional who manages large amounts of money, millions and millions and millions of dollars. Graduate of the Wharton School, blue blood, knows your stuff, swims in these waters daily. And what we're going to be talking about is the tightening of credit because banks are losing deposits. They're not lending. I liken this back to the recession. We saw similar activity where all of a sudden, before we started, I was talking about I was doing a loan with Lehman Brothers on a commercial building, and I said to them, it's almost like you don't want to loan the money. And I took my business elsewhere, went to a regional bank, closed within 30 days, and lo and behold, Lehman Brothers goes bankrupt a couple months later. And I just remember going, Jiminy Christmas, they just can't say they're about to go out of business. A lot of banks are in that same area. And so we want to talk about the opportunities that creates for you, and at the same time, what are the risks involved with those opportunities? So I'm going to hand it to you. What are the opportunities in this market, and what are you seeing?
Well, I think the immediate opportunity is you're seeing investment funds that are stepping in to fill the borrowing needs of legitimate borrowers today that, like you said, are just feeling like, hey, doesn't feel like the bank wants my business, or they're way too slow, and they've got a business to run. So you're seeing more and more funds step into that gap and begin to provide those lending needs.
The lending needs that you're seeing, is it Joe Public, or is it large Amazon and other companies? Like, are we talking corporate bonds? Are we talking everything? Is it
the biggest opportunity, I think, are the lending to small and medium-sized companies, as well as real estate-backed loans. So these are funds, for example, that are lending as a first lien, collateralized by real estate. They typically will specialize in one type of real estate. There's a fund that we invest in that does just real estate loans backed by residential real estate. There's another fund that does predominantly commercial real estate. So
be careful with that one, right?
Yeah.
Commercial is going to be a hot potato. Hot potato, hot potato.
Well, so one of the things that's important is when you're doing this kind of lending, if you're lending now, you have the benefit of knowing that things have changed. You need to be smart about the risk that you're taking. And a lot of these loans are done with a relatively short-term tenors. So you're not locked in for 5, 10, 15 years. These might be funds that are investing in 1 to 2 year loans. And so that helps reduce the risk as well. And a lot of these borrowers, again, they're not distressed. They're just stressed by the process of working with banks, and they don't want to wait forever to get the loan.
And it kind of goes like this. So a bank, you get a deposit, you put your deposit in with the bank, they take that, they're able to do fractional banking, they're able to loan that money, that dollar out. Let's just say in a perfect world they didn't do that, and all they did is loan your dollar out to somebody else. Deposits are shrinking, right? And their assets are shrinking as a result because they show that as a deposit, unlike your neighbor, the custodial account at a financial institution where it's your money and it's bifurcated. In a bank, their assets are shrinking and they're not able to loan.
That's right.
And if you are somebody who needs to borrow to grow your business, you're all of a sudden in that weird situation where the bank is talking a good game, but they're not moving, you're not getting the funds that you need, so you're going to go to an alternative, which is the private market, and that's what you're doing. These funds that somebody would invest in, are they syndications? Are they something that I could do as an individual? How do I get access to these?
Yeah, they come in different flavors. They're syndications, they're partnerships, different structures of funds, and that's where it's helpful to have a team to be able to come to and help you source them and do due diligence on them. But the theme is really that, hey, where banks are struggling, there's new opportunities that are arising for investors like you and me. Mm-hmm. And the interest rates now are high enough that the rates of return now are attractive. So if you're making 8, 9, 10%, with either monthly or quarterly distributions on assets that are not levered and where you have collateral. For a lot of people, they say, hey, this serves a good kind of medium risk, medium return. I'm not looking to bet the farm. I just want to stay ahead of inflation, and I want to get some cash flow along the way. This can be a very helpful.
We're seeing this with folks that had, for example, real estate loans that were 2-3%. They don't want to pay them back, and they have the cash, and they're basically they could be paying off that loan, or they could put it out there to go generate some income. And then they're sitting there going, should I put it in that CD that's paying me 4.5-5%? Should I put it in the money market that's paying me 4.5-5%? Or should I do this? And you're getting 7-8% returns. Is that kind of the target in these?
I think 7-8 is very doable, and if you have access to firms that specialize in this area, I mean, there's also ones that are making a little bit more than that.
Higher risk, obviously.
Well, let's talk about risk in 1 second. I want to first talk about the tax side of it. So when you are making these returns, it's also even more attractive if you can locate this asset inside your self-directed IRA or your self-directed Roth, or even inside your company. It could be a defined benefit plan or a cash balance plan. So that's the other way that people have been benefiting from using this kind of strategy, because then you're not paying tax on it.
Yeah, because if you're making interest, let's say that you're invested in a fund and you're making interest, it's ordinary income.
It's ordinary income, very high.
Yeah, so if you could put that into a IRA, 401k, defined benefit plan, or whatever,
exactly,
then it's exempt. It's not going to be taxed. Or it's going to be deferred. It's not going to be
taxed. It's compounding at a really nice solid.
Or an HSA. Let's just throw that out. That's the triple threat out there. If you don't know what that is, health savings accounts. Those things are awesome too. But you could be investing in these. Only accredited investors, or can other people participate?
Other people can participate, but I would say there's still well over half still have minimum requirements,
and that's fair. Now you mentioned there was 2 opportunities. Right?
Yeah, well, actually, I want to go back to your comment about risks. I think that I'm glad you asked about that.
Okay.
There's always any type of investment strategy has risk, and this is no exception. So it's important that you be smart about it. And let me give you 3 different things to pay attention to. So one is leverage, right? I see a lot of people out there who are adding a lot of leverage to this strategy because they're trying to make 16, 17, 18, 20% returns, but it's because they're adding a lot of debt inside that investment vehicle. I would be careful about that.
Don't do that.
Don't do that.
Right, you're not a big debt fan.
I think you need to be very, very careful with that.
They're levering up because the cash-on-cash return looks better that way, right? You're like, oh, this is even faster.
Makes it easy for them to raise money. People go, oh, wow, this is great. I'm making a higher return.
But it's higher risk.
It works until it doesn't, and then it gets really ugly fast. And I, just personally, in terms of our practice, I don't want to lose sleep at night worrying about that. And I'm sure you're the same, but most people don't want to give up sleep for a few extra points.
No. What about the other opportunities? Let's talk about. So let's say we're sitting in a building here. I don't know if it's financed or not. It's not my building, but let's just say this building here has a loan on it, and it just lost 30% of its. It's 30% vacant now because businesses are not making employees come into the office. I think that's probably pretty close to the vacancy rate. Like there's millions and millions and millions.
It's more than that, actually, Toby. I just looked at the most recent statistics. If you look at the top 10 U.S. metro areas and look at the office buildings, their physical occupancy, which is reality, right? I mean, the leases can lag, but the physical occupants today, 50% still.
50%. All right. So all of a sudden you have a note that might not be performing, or it's going to reset. I think we have over $1.5 trillion of resets coming in the next 3 years, which means they're going to be, all of a sudden the debt's going to be much, much higher. The cost of that debt's going to be much, much higher. What's the opportunity there? Are they going to be selling off these notes? Is there going to be an opportunity to come in and buy distressed notes?
Yeah, so there's 2 flavors of the opportunity. One, you're going to have professional investors that are just upside down and walk away from it. And that property will be taken over by a servicer. And that'll then be sold at a significant discount. And so we've seen already examples this year of that happening quite a bit. It's happened with a couple large-scale malls. It's happened with some big office towers in San Francisco most recently, and including a couple large hotels, where the professional investors have just
they're walking away and they're saying, we're done. And it's like here in Vegas, for example, I always use examples of stuff that I dealt with. You had banks that took back a lot of properties. They foreclosed on those properties, but they weren't in the business of being a landlord.
Right.
So they would just sit there with this, we called it shadow inventory. There's all these vacant houses. And we would work with the banks to maintain them. Like that was a lot of investors, just like myself, said, hey, you know what, let's go out there, we'll mow the lawn, we'll make sure it stays clean, we'll make sure that it doesn't look like it's a vacant property so you don't get squatters. But they weren't in the business of being a landlord. They were in the business of being a bank. They're going to dump those properties eventually. We were buying them up like crazy. BlackRock was buying them up like crazy. Everybody that was an investor was salivating, saying, give me a bank tape, right? That was always the thing. Is that going to happen? Are there going to be these types of assets?
That's already starting to happen. And if you think about it, those failed assets, think about how hard it would be to take that asset, go to your local bank and be like, hey, I'd like to get a loan on this failed asset.
It's not going to happen.
Your local banker is going to cringe and kind of pull away from you immediately. So those often are sold all cash, which means there's fewer buyers, and those buyers have even more leverage in terms of negotiating lower prices.
So how do we participate in that? How do I participate in that? If I don't have a banking relationship, I don't know, and I'm not going to buy a building that's in distress or whatever. But how do I participate if you're like me and you want?
You just mentioned the magic word. That's distressed. So there are distressed investment funds that do exactly that. So they either buy the hard asset, or as we were talking about earlier, they'll buy that paper, the note, from the bank at a huge discount because that bank has already taken a write-off against that. So the bank will sell that paper for a significant discount. The funds will buy that paper, foreclose on the asset, and then either sell it or operate it for a little while.
And you can find these funds. You have access to these funds, I take it?
There's a number of funds out there. We work with a number of them. It requires a little bit of sophistication because you have to. It's a different it's a different process than normal. But it's a very, very common strategy that's been around. I mean, because every 10, 15 years we have a crisis,
Go through
right?
the cycle, right? It seems like it's cyclical and you keep dealing with it over and over again. Last time the government screwed it all up by bailing out the banks and instead of letting us just buy the notes and deal with the borrowers, the banks pretended to do the modifications and they took the government money and they hosed all their borrowers. Because I know because before the bank bailout and after the bank bailout, we were doing modifications, and it was so much easier before the bailout. After the bailout, the banks lied to you through their teeth. They wouldn't mediate. They'd pretend
they wouldn't
like
work
they were.
With you, no.
Yeah, there was no incentive for it.
No.
The government got involved. So hopefully the government stays on the sidelines and lets the market do what the market should be doing, which is, hey, there'll be folks like you who are funds that come and put together monies to go out and take over these distressed assets in profit as a result.
And it's funny because the word distress is kind of scary, but don't let it scare you because if you're on the right side of that transaction, it can be, in my opinion, less risky than going out there and paying a market price for some asset. I mean, you're buying things at significant discounts in complicated situations, and that's why you're getting paid very, very well in those funds. Now, you have to understand these funds do not pay out money every quarter or on a regular basis. The way these funds work is you make an upfront investment, and you should count on having to hold that fund for 3 to 4, maybe 5 years. And it's towards the end of that where a lot of these realizations, the profit then comes back to you, your principal comes back to you. So it's just a different style, but those higher return, distressed investment type funds, don't expect cash flow along the way, but there's significant opportunities.
Yeah, you're doing a long-term play because the market at this point in time is tight on the credit. Banks are suffering. Banks are losing deposit. There'll be more bank failures, and as a result, there's going to be, and they're holding a ton of this paper anyway, you're going to see the credit markets tighten, and you're going to have private individuals going to have to step in there.
Yeah.
And you're going to see funds looking to take over the asset, and you're going to see funds putting together lending opportunities where you can participate and you can become the lender. And hopefully the government stays on the sidelines and quits
I sure
messing
hope so.
with these things, because the last time it would have been much better off for everybody had they not done that.
Much
Bailout.
better.
That's my personal opinion.
You know, one of the hardest things too for people who, you know, what happens is a lot of these deals start getting marketed, and you start seeing people trying to sell you an investment in a property that, you know.
We're already seeing it.
Yeah.
You see, like, oh, here's an office tower, and you could own a high rise and all this stuff, and I'm like, it's empty, isn't it?
There's an old phrase, "Don't catch a falling knife," and it's hard because the initial discounts look really, oh, it's 30% off, but I just would encourage you to be, as hard as it is, say no more than you say yes, and just be patient. Wait it. This is gonna be a slow-moving train wreck, not a overnight, oh, I missed it kind of deal. So don't be afraid of saying no. You know, get an extra opinion if you need to, but don't fall for the hype. The people that are patient and really wait for those opportunities tend to do better.
Well, that's good advice. And so obviously we're just bringing up something that's going to be an opportunity, and it's giving you the making you aware so that you could take advantage of it and do and benefit as a result. And it just comes down to this: the market needs these products and they need these funds, and they're willing to pay for it. And normally they go to source A, which might be the banks. That's drying up, so they're going to go to source B, which is you and me, as part of these funds. And you're going to get introduced to those funds through somebody like a Stefan. Find a fiduciary who is a money manager and get access to these things the right way. Don't go out there and look on the internet and see what, soup du jour. Be very, very careful about this and make sure that you have somebody that's guiding you along the way. Thanks, Stefan, for coming in. Because pretty
You're welcome.
enlightening.
Fun to be here.